All right, so welcome again to another video of ours. My name is Robin. I'm joined once again by Kirill. And today we're going to talk more about stocks like we did last time. This time it's going to be about Meta. It's a company that I hold close to my heart because I have had all the highs and all the lows with this company over the past, I think, 1.5 years that I held it. I don't hold it anymore, but still it's something that I experienced. So I also know a bit about the company myself. And yeah, we're gonna walk through it and see what the company should be worth right now, as of today. So first things first, we're gonna try to make it more concise. If you want to know more about the metrics, you can just watch our older videos. Either way, so if you plug it in on our tool, so Meta USA, you're greeted with this screen. You get some information, some summary statistics, but also the summary about the company itself. We scroll down and you're immediately greeted with the company's foundations. So here we can see all the good things that you want to see when you're buying a company. So we want to see revenue growth, net income growth, free cash flow growth, all the good stuff. We can also see that the long-term debt by free cash flow is also covered, meaning that if need be, they could also just sell off all their debt and be done with it. So this is really nice, especially now what there may or may not be a recession inbound,
We'll see.
Exactly, you never know. So it's good that they have like a really solid position and they're able just to get rid of all of it. So they have share buybacks, which is really good to see. It means that basically your shares get more value as time grows, as they buy back more shares, because less are available on the free market, let's say. Yeah. So this is something you really want to see. The other way around, you don't want to see, because they will dilute you. And sometimes they do this if they want to make a purchase of another company, for example, but it's generally a sign you want to avoid. Dividend growth, Meta doesn't have any dividends, so that's something we can skip.
Yeah, it's a tech company, so they do not really,
they just
you do not buy it because of the dividends, of
exactly.
course, yeah.
And even so, in the end, it doesn't really matter in the long run, because in the end, on the ex-dividend day, everything is just leveled towards where the dividend was. So it doesn't really
usually
have a
but
big
it
effect.
Depends, yeah.
All right, so this is basically the income statement. Due to the statistics above, you don't really need to check this out. I mean, you can scan it and see if there are any mistakes or some anomalies you want to check out. You can check out our video on Tesla, for example, where we dove deeper into what happened with their debt. But for now, we can just skip it. So we can see the free cash flow growth and also the long-term debt.
Yeah, like probably what's important to highlight is what I also noticed, because I also had my chunk of luck, let's say, investing in Meta, but when I, quit after like that 2022 issue, like with the war in Ukraine and everything, when the whole market pretty much went down. But as you can see here, like for the 2000, I think that was for 22. Yeah, so for 2022, Meta actually had some tough times with their free cash flow. So if you remember, Meta was heavy in VR, in all the reality lab, but then it's actually not very lucrative. It doesn't really pay out because people, there's no such a demand as it was expected. So, and
besides also they had TikTok coming up, taking a lot of their user base, struggling with the competitors, basically.
So Mr. Zuckerberg now has an issue to make sure that actually the free cash flow is going back to normal and then actually improve. So that's also something to consider in the future.
Exactly. So then we find the statistics, and these are based on a book written by the daughter-in-law of Warren Buffett. I will link it down in the description. Basically, we can see whatever he likes. So he would like to see high or above 20% net earnings ratio, low interest expense ratio, low research and development ratio, low selling in general, low depreciation, and basically those are the metrics that he looks at. So here we can see like this is the issue that you're talking about right here. So that's that they basically declined in their free cash flow.
Yeah, because they've been increasing their expenses, right, on the reality lab. So they did quite some R&D.
But still they're around 20%, which is really good to see, by the way.
But if you see the R&D, right, that's something which is getting out of hand, let's say, already a little bit.
So why you want R&D to be low is because basically if you have a moat around your company, you have a competitive advantage, you don't want to invest a lot. So for example, if we would plug in Coca-Cola right now, you would see that they invest zero. They have their brands, they just do their marketing pushes, it sells itself. And basically they have such a giant moat with their brands, don't need to develop other flavors, let's say. And here you can see the increase because of Meta, because of the metaverse that they are trying to achieve. they need to invest heavily, and that's also why you see the increase in R&D. And if that's something that you want to buy into, because that's basically what you're buying, so you're buying the belief that the metaverse is gonna, explode and pick off, then this wouldn't worry you so much, let's say. But it's something to keep in mind.
Yeah, it depends. Especially like it's rather speculative, right? Because with Meta, as you can see, they still need the money, let's say, to sustain their mode, right? So which is also something which the company might not be able to do in the future, right? Because of the competition and stuff. So that's also something to keep in mind. So even though, let's say, the financials of Meta are rather good, it doesn't necessarily mean that we will be able to sustain them in the near future. And it's also your due diligence to dig into it further.
Yeah, exactly. So then again, free cash flow per share outstanding. Well, we see that this is increasing, except for this year when the free cash flow is lower. But this also doesn't surprise me because they also had their share buyback. So the less shares also on the free cash flow. So besides that the free cash flow is growing, there's also a smaller pool of shares.
But it's only like 2% a year, I think, on average for the past 5 years. So it's a drop in the bucket, let's say. So it's not that big, But it's nice to have. It's of course nice to have.
So this is good to see that this is also like increasing. It has a dip this year, but we understand why. And
also maybe another thing to consider if you go, so selling in general expense ratio is also getting to the higher 50s to 50%. That's also not a good signal because again, the question was mode. So if a company actually needs a lot of marketing efforts to sell its products or services, then it means that either there's no such a demand from the customers themselves, right? So they got to push the products or services to them, or there's something else they spend quite some money on, which then also results in the decrease in free cash flow. So keep that in mind as well.
And then again, we just look at the some of the criteria discussed before, free cash flow growth. Well, we can see that even though it's declining, so a huge decline here, of course. But the revenue is still growing, except for this year, or at least that was 2022. So that's what we discussed indeed.
But on average for the past 5 years, it's still it's very great numbers. I mean, of course, it's big tech, no doubt. But then again, you got to keep in mind there's still competition with the TikTok, with YouTube, with other, let's say, ad generating businesses, right? So that's where their money come from. So it's still good. It's still a good result. So.
So this is your part, the fund-to-mid investing ratios.
So as mentioned in our previous videos, this guy, Mr. Terry Smith, is one. It's like Warren Buffett, but of Great Britain, let's say. And these are, let's say, 5 of the metrics he uses in order to evaluate his stocks he would like to put in his fund. So it's return on capital employed, gross profit margin, operating profit margin, cash flow conversion, and interest cover. Simply put, the bigger the better for all of them. And as you can see, at least for the past year and in 2019, Meta was actually doing quite a great job, especially if you can see the return on capital employed of 23%. That's good numbers. Gross profit margin, operating profit margin is getting lower, so 25% out of 80% from gross profit. So then again, the expense side is there, and it's quite hefty. But and then interest cover, as you can see, for the past years of 2022, they are able to easily cover up their debt. They probably got it during COVID times when the interest were rather low, so it's free money, and they're able to cover it up rather quickly. So it's good.
Indeed. All right. So then we come to the valuation side of things, and basically what that means is that we're gonna use our tool to determine what it should be worth. Again. As with all our videos, please read the disclaimer. None of this is any financial advice, just educational purposes. And it gives you a bit of a direction on where to look at. And you should still do your own due diligence. But it's a starting point. This is again
exactly. So this is rather like a screening tool, which allows you to maybe choose some certain stocks you would be interested to dig into further before you're doing your investment decision, either to buy or to sell or to not even buy in the first place.
So we start with the future growth. So for the sake of simplicity, let's just go to Yahoo Finance. So just look for the ticker. So Meta Platforms. So then we want to go over to analysis.
Look at that, some nice res going on today, huh? Good to see.
It's good for our inverse S&P.
Okay,
then if we go all the way down, you will see that they expect per year for the next 5 years, a 30%
Oh,
growth.
wow.
That's insane.
This
Used to be different though. When I bought into Meta, this was way smaller. But
it's the analyst estimates, right?
Yeah.
I think.
So, but let's put it maybe on like 15 just to be a bit more.
Yeah, I think for the past, if you can just put 15 there. So if we just go real quick and see the average for the past 5 years, right? So that was in the ballpark of, so revenue growth was 21%, free cash flow 16%.
Yeah,
so if we assume, let's say, rather realistic scenario, there will be some competition, let's say, right? Still some chunk of revenue is going to be eaten out by like bigger competitors, let's say, like TikTok, maybe YouTube. Yeah. So, 15 is rather like a safe bet. Yeah,
exactly. So then we want to know the PE ratio for the past 5 years. So where you go is you go here to microtrends. Again, search for Meta. It's not hard to find. Doesn't matter what you click on. Just skip the ad. Yeah. So price ratios. PE ratio. Sorry.
Yeah.
Okay, so then we put it on 5 years, and then the PE ratio high and low.
Look at that nice dip. Oh, that.
This is something
that
where
was tough, right?
This is where I bought, and this is where I was holding my my horses basically.
Yeah.
But so we can see the high should be around is here. It's like 35-ish, and the low is like 12.
Yeah, to be safe. Yeah, so if it went down as low as 12, and
yeah. So 35 and 12. All right. So for the required rate of return, I put this normally at 12%. As with our videos, if you invest in S&P, you likely have a yearly return of 7.5–10% on your return. Because this investment is a bit more risky, because you're stock picking, you want a higher rate return, 12%, discount rate 12%. You can do these things as you go, and then I like to do my margin of safety at 20%. You can do these higher or lower, but basically a higher margin of safety is going to give you a lower estimate. So I always recommend just to find whatever you're comfortable with, but you can also play around. So sometimes what I do is just see, if, for example, if the margin of safety holds at 20%, if it's in the buy range, and then up the margin of safety to see in what ranges of safety the prices will fall, basically. But now we just leave it at 20%. I do something now that you always do or like to do. So would you put it at 2 years or 5 years instead of 10 years normally?
I think it also depends on the business, right? So if it's something rather, let's say, risky or something very disruptive, like for example AI or whatever, that is something which you cannot really predict long term. With Meta, what you got is like Facebook, you got Instagram, you got all these developed platforms. Now you also got Threads, which is a competitor to Twitter.
Exactly.
Right?
Grows fastest platform since TikTok.
Yeah, but I mean, in this case, it's already an established, let's say, brand, established business, and they have the well-developed business model. So maybe even 10 years, it's sufficient in here.
Yeah.
But you can always play around with it depending on your preferences, let's say.
But yeah, let's say 5 years.
You can put 5 or 10. Yeah, sure.
So 5 years, we press the analyze button. No.
If it will,
There we go.
Yeah.
So basically just now running the numbers, and then we'll be able to see. So we got the average valuation of all of these formulas, basically 195 euros and 35 cents. So meaning that you would likely buy at 156. The current price is 297.
Yeah, and then probably also if we bump it up, let's say to 10 years, of course the discounted cash flow formula is gonna increase, right?
Yeah.
So let's just try that, for example. How's it gonna look like? Because then in this case, like let's say for me, Meta is a nice business. The only thing what I'm concerned about is that they do not, in my opinion, have like the sustainable mode.
Yeah, so then it's closer, but it's not there yet. And you're right, because with Meta's modes, basically they're huge numbers, but they also have a problem these days where they can't grow their numbers anymore. So basically they're going to other countries to install Wi-Fi to get people onto Facebook. But yeah, it's not sustainable, and it's just...
And also WhatsApp, right? There's still a lot of room to monetize WhatsApp, for example. And that one is probably the biggest it is the biggest messenger in the world. But then there's also like still quite some know room in terms of like, okay, how do we make money out of it?
So yeah, basically that's some insights for you on our stock analyze tool.
Yeah, and also on top of that, if you're interested and if you, for example, would like to save these valuations and your assumptions, you can always click the save button, and it's actually gonna put it in your watch list. So you can just keep track of all your investments in the tool. So, and also, for example, we also something called a valuation tracker. So you can also see, for example, what's your fair value according to your, let's say, estimate and your analysis, and what's, for example, the ranges in terms of being overvalued and undervalued. So everything in, let's say, in one pocket. Yeah,
Exactly.
pretty handy.
So you can go to our website, links in the description. Feel free to download it. I still believe that we have our offer running, so the first 15 people get it for $1.
Yeah.
And then afterwards it's a one-time fee, $15.
Yeah.
So that's it. We'll see you in the next video, and yeah, thanks for watching.
Have a good one.